Well, as the focus this morning is on GDP, my next guest makes the case that the economy will bounce back much stronger than other forecasts. He's Jim Paulsen, the optimistic chief investment strategist for Wells Capital, and he joins me now from Minneapolis. And Jim, always good to see you on our program.
Good to be here, Betty.
And I read that Barron's article about you with interest a few weeks ago, saying that essentially you see the economy bouncing back to 3.5%. Why is that?
Well, you know, I think that I don't disagree that the consumer is going to be less of a force going forward than it has been. But I believe that a lot of that decline from the contribution of the consumer, Betty, will be made up from a switch from where we've had a loss every quarter from the trade deficit worsening to where now it's starting to be a growth generator by producing positive growth as it improves. If for example, Betty, in the last two expansions, we probably grew GDP around 3%, roughly. Mm-hmm. And of that, the consumer contributed 3, business contributed 1, and then we lost 1 through the trade deficit. Going forward, let's say the consumer has to really slow down, and let's say rather than giving us 3, they only give us 1% growth. But if that happens, we might get 1 from the business sector, and we get 1 from trade. And if we do, we could grow at the same rate in the next expansion that we grew in the last expansion, just with a very different composition of growth. And I think that's what's really going on.
Jim, where's the evidence for this, though?
Well, the evidence is already there. It's happening now. For example, trade has been adding about 1 to 1.5% to our growth rate during much of the last couple of years already. Trade started to turn right ahead of this crisis because the dollar had been falling since 2002 and started to change relative spending patterns around the globe. Mm-hmm. So I think it's already been contributing. Today's GDP report, one of the biggest contributors to growth today, will indeed be net exports.
Well, how long do you see this happening? Because I must say I have my doubts, Jim. For instance, China, right, one of our biggest trading partners, they're having a tough enough time stoking their own domestic demand. How in the world are they going to make up for that demand in the U.S. by actually buying our products?
Well, I think that the emerging world really is where the growth is. I mean, they've got young demographics, they've got savings, they got newfound desires over there. It's the West with old demographics, over-indebtedness, lack of savings that needs growth. I think what's going to happen, Betty, not quickly, but slowly over the next several years, is the Western developed world currencies are going to slowly erode against emerging world currencies. That started to happen again right ahead of this start of this crisis. For example, there has been weakness already of the dollar against the yuan and other currencies. Mm-hmm. And the trade deficit, for example, with the United States against China, India, and Mexico right now, in the last year, that started to improve for the first time in more than 15 years. And so I'm not saying it's going to be a watershed. I'm not saying it's going to totally replace, a little weaker consumer. Yeah. But I do think it's going to be a force that's going to probably make things turn out a little better in the United States than what people believe.
But, Jim, does that mean that for at least the, not even the short term, but the long term, that you're not counting on American consumers coming back, that there's a new normal there you're conceding?
Well, I definitely can see the same things the bears are seeing with the consumer. I guess my feeling, Betty, on that is, yeah, I think the consumer is going to contribute less in the next decade than they have in the past as savings are replenished and debt loads are lowered. But I guess I'm not quite as pessimistic. I don't think they're going to go away or be negative growth. And I think even going to 1% is probably too pessimistic. If I had to guess, I'd say rather than give us 3, they give us 2. The savings rate's already up to about 7%. And if it just stays at 7, if it doesn't go any higher, then we can continue to deliver more and more savings, but you can grow consumption at the rate of income growth. And then suddenly the consumer's the same force they were, and they're also replenishing savings.
Okay, Jim, before I let you go, though, put your investment strategist hat back on. Tell me then, how do you invest into that scenario you're talking about?
Well, I think, Betty, when I think of the investment markets today, the thing that impresses me most is the amount of operating leverage that we've produced in the corporate sector. Because of the fear generated by this crisis, corporations have been sizing themselves for the second coming of the Great Depression, and they have gotten so lean and mean. And I think you want to take advantage of that. You don't go to consumer staple stocks or healthcare or utilities for profit leverage. You stay in the more cyclical areas, and my favorite right now is the industrials and the basic materials. But I also like, the technology and even some of the consumer discretionary plays.
Okay, Jim, we're out of time. Good to see you again, as always. And by the way, have a good weekend. Jim Paulsen,
Thanks,
Chief
Ben.
Investment Strategist at Wells Capital Management. Of course, I'm sure he's sticking around to watch the GDP numbers.